And so sometimes the biggest thing with the deferred sales trust and working with us is realizing that it's something you probably already have been doing in the past. You gave up some indirect control. Can I use the deferred sales trust and still sleep well at night, knowing that I didn't give up too much control? That is the subject of today's video. Hi, I'm Brett Swarts, founder of Capital Gains Tax Solutions. We help you create and preserve more wealth by deferring capital gains tax using a deferred sales trust at the sale of your highly appreciated asset. In today's video, we're talking about one of the top objections we receive from potential investors who are looking to use the deferred sales trust, and it's the control aspect. You may have owned a business, real estate, a primary home, cryptocurrency, and the biggest thing is you've been in unilateral control. What does that mean? That means you have the ability to make decisions on your asset unilaterally without having to ask or do anything different than what you've always done as far as ownership. Although, if you have a lender on your home or your business or your real estate, you do have to work within those parameters, and that's exactly how the deferred sales trust works, because guess what? You become a lender to the trust and you have to approve of investments and movement of funds. But we'll cover that in the very last part of this video. I do want to talk about the kind of the top ways to make sure that you don't give up too much control. And there's really 6. And the number one is no commingling. You want to make sure that every part of the deferred sales trust that's set up for you is only exclusively for you and or your family. It's for nobody else. And by family, I mean direct, either spouse. If it's multiple family members in like an asset that are selling, different parts of your family, they're going to have their own. Own married couple or own single individual would have their own. That's how precise the deferred sales trust should be for you, or any other trust that you're considering. You want to make sure there's no commingling of funds. You're not going into like a pooled investment or a pooled trust. Now, the trust, once it's in the trust, it can go into other investments and it can be diversified into pooled investments, right? But the actual account, the entity, right? The tax return for the entity, the business that the entity is doing is exclusively for you. You want to make sure there's no commingling. And that is the number one way to make sure you can sleep well at night and not give up too much control with the deferred sales trust. Number 2, you want to make sure there's third-party banks and financial institutions, as well as third-party investments and a third-party trustee. So here's the key when I say third-party. I don't just mean one group that has the trustee, the financial advisor, and all of the investments all under one roof. In fact, it's best to have each of them third party, not only to you, but to one another. And this creates more transparency, more accountability, and really just more sets of eyes and ears on the trust to make sure that your interests are being served. And that's so important to have a third party individuals and professionals, as well as third party banks. With the deferred sales trust, they're typically using some of the largest banks in the world, TD Ameritrade, Charles Schwab, to house the funds. Also large commercial banks as well for our commercial real estate and investment type real estate entrepreneurial clients. So that's number 2, make sure everything is third party so you have that protection and transparency. Number 3 would be the workflow for the actual approval of movement of funds, whether the movement of funds be into investments or whether they be into just paying fees for the trust. You want to make sure there's a workflow in place that nothing ever moves or is paid or is sent out from the trust without your approval, right? And that typically looks like a signature on a page, digital signature to start with. So that is number 3, the workflow and the approval of investments and the payouts. Number 4 would be transparency and access to statements. You want to make sure that you can log on and see where the funds are invested at, 24/7 access, and you get view access of the accounts as well as downloading of the statements. That is so important to just, any time during the week, any time during the day, you can log on, you can see where the funds are at, and you can also start to track and see the performance, okay? That is number 4. Number 5 would be third-party DST tax preparer. Okay, this kind of couples with number 3 or number 2, but I think this is key because each year the deferred sales trust, there's a tax return that's being filed, and so you want to make sure there's a third-party tax preparer, tax professional, CPA, that is doing the trust tax return. And the key here is not just doing the tax return, but they're looking for any inconsistencies with any of the fees, any inconsistencies with the investments, and they're also looking at as that pertains to the promissory note payout to you. And so it's great to have, it's sort of like a auditor that's built in, because part of the tax preparer should be looking and kind of basically making sure the numbers at the end of the year are equaling the expenses and the numbers. Everything's basically accounted for. Okay, that's what they do. So make sure you have a third-party DST tax preparer. That it's best to have another set of eyes on the statements and to look for any inconsistencies in the number. Number 6, this is kind of one that's kind of overlooked. In fact, it's probably the number one reason I started the Deferred Sales Trust, become a trustee and started the Capital Gains Tax Solutions, and that's actually checkbook control, which is really, really, I think, fantastic, because as an entrepreneur or as a real estate owner or someone who wants to be really active in the participation of working with the trust to achieve a return that's ultimately going to pay you back, you can joint venture partner with the trust. And what that does is gives you the opportunity to open up a brand new LLC, partner with the trust, and become the managing member of that LLC to be able to invest in other investments. Now, it does still take the approval of the trustee for those investments, okay? So this isn't something where the money just sits in an LLC hanging out waiting for an investment. It needs to be priorly looked at and approved by the trustee. That's part of our role here at the Capital Gains Tax Solutions. So we want to make sure that everything's set up. But in that scenario, you open up the bank account in the name of the LLC, you open up the LLC, you're filing the tax return for the LLC, and you're working with the trustee, and you're working with the trust to invest the funds into, let's say, a Airbnb property or a new business venture or a new multifamily complex. That's an amazing way to make sure that you can, I think, feel great about the Deferred Sales Trust and sleep well at night. Now, I promised I'd give some examples of how you may be already doing this. You may not be realizing it. In fact, have you ever done a 1031 exchange? Do you realize in a 1031 exchange, you are giving up control for a period of time? In fact, it's typically 45 to 180 days, depending on if you've identified properties in time or de-identified by the 45th day, and or are waiting for those properties to either close on the up leg and or waiting for the 180 days to expire. The 1031 exchange accommodator says, look, we take control of your capital for this period of time to make sure we follow these rules. So the 1031 exchange, which is really interesting, I have a lot of people approach us and they say, hey, I'm concerned about this control thing. And I say, well, have you ever done a 1031 exchange? They go, well, yeah. Were you concerned about the control thing there? And they say, well, no. And it's like, well, why? Well, because I was used to doing it. And so sometimes the biggest thing with the Deferred Sales Trust and working with us is realizing that it's something you probably already have been doing in the past. You gave up some indirect control. Now, there is a difference in the sense that you don't own the trust, right? You own a promissory note that the trust owes you back the money, right? Or with a 1031 exchange accommodator, you don't own the accommodation company, but you put the money in there, and they're required to pay it back to you for you to pay your tax or to cooperate with the 1031 exchange. So the Deferred Sales Trust is kind of like a long-term 1031 exchange accommodator, except in this scenario, it's accruing interest and it owes you the money. And so that's interesting to look at that, right? Those scenarios there, but I think you're getting what I'm saying here. So think of a DST kind of like a long-term 1031 exchange company as it pertains to giving up some control for a period of time. Also, you may have invested in passive commercial real estate investments. I know I do, and I know I'm giving up control, and these are typically 3 to 5 years or 5 to 7 years where you're entrusting a third-party group to invest in this multifamily complex, mobile home park fund, multifamily fund, it could be other business venture, and you're giving up that control for a period of time. Well, guess what? The Deferred Sales Trust can invest in those same things, except it's going to stop into the trust first, and then it's going to go into those other investments. And so my point of all of this is you might already be giving up control, and perhaps you're not maybe connecting some of the connections, or maybe you are. And so hopefully now you are more after this video. And if we can help you at all, we'd love the opportunity to work with you and to make sure you feel 100% comfortable with how the Deferred Sales Trust works, what the workflows are, so you can sleep well at night knowing that you didn't give up too much control. Again, it's just a quick review. We want to make sure that there's no commingling, right? Everything always has a third-party entity that only does business with you. Number 2, using third-party banks, financial institutions, as well as third-party money managers, financial advisors, and third-party, let's say, commercial real estate operators to invest the funds in. Although you can also be active as well. You can partner with the trust. That as well. As well, you want to make sure you have a workflow of approving of the funds when they're moving. investments or fees, which leads into the next one, which is transparency and statements, making sure you get 24/7 access to view everything online, as well as having a third-party tax preparer. That tax preparer is looking for any inconsistencies in the numbers. And then again, number 6 was the joint venture partner having like checkbook control to be able to invest in third-party investments or even active investments that you're looking to go into. So if we can be of any help to you, you want to take action right now, go to capitalgainstaxsolutions.com. Look for our new book, Building a Capital Gains Tax Exit Plan, that just is being released here in a couple days on Amazon as of April the 20th, just in time for tax day. Hey, I so appreciate you watching this video, and we look forward to connecting with you soon. Bye now.